Hi, I'm Chris Pilo, founder of Simply Direct Financial. Simply Direct Financial was built on the premise to save you money and to provide ongoing value for our clients. Let me go through a scenario here. It'll take a couple minutes, but if you just follow the math, you will understand exactly why my method of refinancing and my mortgage platform is so much better than the big banks. Big banks are in business to make money on interest. They're not in the business to keep refinancing clients when rates go down. They make money on interest, not us. So, mortgage management. We have a client, and this is an exact scenario that actually happened. We have a client, let's call him Client A. In December of 2006, this client got a mortgage of $417,000. His rate that he got was 6%. His payment every month was $2,500, but he spent $7,900 in December to get that. We weren't part of that refinance. The rates dropped, and in January of 2009, this client called us. So in January of 2009, this client had a balance of $405,000, and we refinanced the client at 5.25%, and his payment went to $2,239, which is a savings of $261. Those savings were immediate, and the break even was immediate because there were no closing costs whatsoever. Whatever the remaining payoff is was what the new loan amount was. Okay, great. So we tracked the market, and of course what happens in October of 2009? October of 2009, rates drop. And of course, this client's balance at this point was $401,000. So we don't add $8,000 of closing costs to the loan. We simply take his balance and we make that his new loan amount. So his loan amount was $401,000, which was what the payoff was, and we dropped his rate to 4.875%. This client again spent zero closing costs, and his payment dropped $117 a month. Okay, fast forward a little bit, interest rates drop again, and in September of 2010, this client had a balance of $395,000. We were able to get him a rate of 4.5%. Yes, it's only a third, or it's only 3/8 of a point drop from here, but it was for free. He didn't pay any closing costs. His savings were $119 a month. Fast forward, October 2011, rates drop again. We refinance the client. His payoff is $388,000. That becomes his new loan amount. We drop his rate to 3.75%. His payment is $1,796. Once again, he spends absolutely no money, zero investment, outside of just collecting some documents, and his payment dropped $207. If we were to summarize this scenario from January of 2009 till October 2011, the client saved $704 a month, and not once did we ever charge him any closing costs. Not once. Whatever his payoff was his new loan amount. Now, let's evaluate Client B, which would be a scenario that the too big to fail banks are going to be offering you. Once again, we know that these big banks, they're here to make interest on their money. They're not here to simply do no closing cost mortgages. It's not their business plan. Okay? So, Client B in 2006, which is the same scenario as my client, has a loan amount of $417,000. His rate is 6%. Of course, his payment is $2,500, just like up here. He spends $7,900 to get that 6%. Well, come October 2009, rates drop again. And if you notice, this client is not going to simply do another refinance because he's not willing to spend another $8,000. So he's stuck. Okay. Fast forward, September 2010. If you notice, this client's not going to refinance again because he doesn't want to spend the $8,000 to get a better rate. So he does nothing, and he stays there with a higher interest rate. So if you analyze January 2009, Client A versus Client B, yes, under Client B, his rate will be at 4.875 versus my 5.25, but the two payment differences are only $50 a month difference. My scenario, however, has zero closing costs, and this bank charges $8,000 in closing costs. So it's simple math. $8,000 in closing costs divided by the $50 payment difference gives you a break even of 160 months. Therefore, it'll take you 160 months to recoup $8,000 just to get a payment that's $50 less. Doesn't make good math. It just doesn't add up, and it never will. So, in summary, it's quite basic, and the math speaks for itself. If we analyze both October 2011 for client A and client B, let's take a look at client A. His loan balance is $388,000. His rate is 3.75%. His payment is $1,796. This client, which is an actual client, has spent zero. Client B, October 2011. His balance is $395,000. He has $8,000 of closing costs. His new loan amount becomes $405,000, which is obviously higher than $388,000. That's point number one. Point number two, and the most impactful here, is if you look at the two payment differences. For client A, which is our client, his payment is $1,796. This client is at $1,790. This client has paid $23,900 to get down to $1,790. So what is that? That's a $6 payment difference. But this client spent $23,900 to get there. So divide $23,900 into $6 payment difference. That gives you 3,988 months. That is 331 years to recoup that money. I think the math speaks for itself. Big banks are wanting to charge big origination fees and big costs so that you stay stuck in your interest rate. They don't manage interest rates like we do. Anytime there's a drop, no closing costs, we drop the rate for you. And it's ongoing forever, and we do that in insurance, and we also do that with mortgages. Give us a shot. I know we'll beat every single one of those big banks that seem to be doing the right thing for you. I'm here at the office. We're right here in Atlanta, serving Atlantans and Georgians first. We look forward to helping you in the future.